Imagine a future where your retirement savings could be invested in a wider range of assets, from private equity to cryptocurrencies. President Donald Trump recently signed an executive order that could make this a reality, opening up new possibilities for Americans' 401k plans. But here's where it gets controversial. While this move could offer greater returns, it also introduces significant risks that could jeopardize your financial security. The potential benefits are clear. According to Robert Brokamp, a financial planning expert at the Motley Fool, allowing investments in private assets means everyday Americans could diversify their portfolios with a broader selection as companies. This expanded menu of investment options could theoretically increase earnings, especially since private assets often offer higher yields than traditional investments like mutual funds and exchange-traded funds, ETFs. However, the flip side is equally concerning. Private investments come with higher risks, particularly due to reduced transparency and liquidity. Unlike publicly traded companies, private firms do not have to disclose detailed financial information regularly. Moreover, selling private investments can be challenging, especially during market downturns, when many investors are simultaneously trying to liquidate their holdings. Fees associated with private assets are also substantially higher. Target date mutual funds, which typically hold a mix of stocks and bonds, charge around 0.3% in management fees. In contrast, private funds can levy management fees ranging from 1% to 2%, along with performance fees that can reach up to 20%. Interval funds, another type of investment vehicle, often carry management fees between 2% and 3%. Currently, private equity investments are technically permissible in 401k plans, although they are not widely available. Some companies, like BlackRock, are exploring new offerings in this space. Cryptocurrency investments are also possible in certain 401ks, but this remains uncommon. Additionally, many 401k administrators do not yet support private equity funds. The executive order aims to change this landscape by directing the Department of Labor to reassess its guidelines on alternative assets within 180 days. It also instructs the Securities and Exchange Commission to explore methods for making alternative investments more accessible to retirement plans like 401ks. Benjamin Schifrin, Director of Securities Policy at Better Markets, predicts this could lead to a surge in private market investments in 401ks, noting that plan managers have been hesitant to include such assets in the past. Employers would need to decide whether to offer these new investment options, and some might be wary due to potential liability concerns. However, with clearer regulatory guidance, they may feel more inclined to add alternative assets to their 401k offerings. Many experts, however, view this development with skepticism. An Tran, managing partner at Sage Mint Wealth and a certified financial planner, warns that inexperienced investors might be lured by the promise of higher returns without fully understanding the risks involved. She advises against making such investments unless one is fully aware of the possibility of total loss. For investors who rely solely on their 401k for retirement, this could be extremely harmful, she says. Without proper safeguards, like limiting exposure to no more than 5% to 10% of the portfolio, investors could face undue risk, unrealistic expectations, and potentially irreversible losses. Similarly, Knud Rostad, co-founder and president of the nonprofit Institute for the Fiduciary Standard, expresses concern that private assets in 401ks could lead to significant financial losses for many savers. He anticipates that many fiduciaries will disregard the executive order, recognizing the potential for widespread damage. This directive could result in a major financial crisis where countless individuals are severely impacted, with their retirement savings effectively destroyed. He explains, cryptocurrencies present additional challenges. better markets. Schifrin points out that there is uncertainty regarding investor protections in the context of cryptocurrency investments. This introduces a distinct set of risks that come with incorporating digital assets into 401ks. On the other hand, the Securities Industry and Financial Markets Association, SIFMA, views the executive order favorably. Kenneth E. Benson, Jr., President and CEO of SIFMA, argues that expanding access to private market investments could enhance diversification, make such investments more accessible to a broader audience, and provide more investment choices for average retirement savers. While these changes could materialize in the coming months, experts emphasize the importance of education and safeguards, particularly for younger investors and those without access to professional financial advice. As Tran notes, transparency, education, and limitations are crucial to prevent widespread harm. Without these measures, we risk not only financial losses, but also broader economic and social consequences. What do you think? Should the government allow 401ks to invest in alternative assets like private equity and cryptocurrencies? Or do you believe the risks outweigh the potential benefits? Share your thoughts in the comments below.